$1 trillion is going to be created this financial year in wealth.
But why wouldn't I put my money into a Melbourne metro market?
House prices are rising 7 to 8% at the moment, all across Australia.
The affordability was high. That was a big one. That was a big sort of tick for me. It was like, oh, relative to the income that these people earn, the affordability factor for the median house price is actually really high.
Which market segment is going to do well? Right now, a property boom is happening in Australia in just about every single major capital market. It is September 2025 and we are in the middle of it right now. In lending terms, investor demand is stronger than ever. We are seeing a flood of loan applications, of pre-approvals, of purchases, and we are seeing this across many different markets in many different capitals, all at the same time. In this episode, we're going to go through the 5 things to watch out for right now, what is happening on the ground, and inform you exactly how to shape your own investing strategy to take advantage of this property boom we're living through right now. Adi, how are you, man?
I'm good, man. I'm good. Yeah, this is a cool topic because we're talking more broadly now. We're not going to specific markets. There is a broader. It's weird because we're talking about a property boom, but didn't we just come out of one? Like, didn't Perth, Queensland,
it's national now.
Adelaide? Yeah, it's crazy. Like, it's everywhere now. Yeah, it's very cool.
Sydney and Melbourne.
I like the broad macroeconomics of this. I think there is a clear theme. Rental pressure, supply is just abysmally low, and everywhere you look, there's something cooking.
It's cooking.
It's cooking, man. It's wild to think that there's more to come. Affordability is going to get worse before it gets better. There's so many things happening, and population's increasing like crazy. It boggles the mind actually. The opportunity that is available if you want to take advantage of it is immense. So this is cool, the time. Right? It is very cool.
We've been doing this podcast for a couple of years now, so we've been through different cycles. We have a Sydney Melbourne slant as well. I think that's fair. We've got it a few times in our comments as well from our audience. Be like, yeah, I'm from Sydney and Melbourne. It does make up a big chunk of the economy as well. So the housing market, the national one, is dominated by these 2 major capitals when you look at the national indices. But so too are the populations of these countries. So we've seen cycles that have kind of sucked for a period of time, like at different points over the time we've been talking about this. But right now it is cooking, like it is very, very strong. And we'll probably touch on some of the things that will turn this around, because this won't last forever.
Of course.
There's going to be a change in the macro setting. The macro setting where everything is rising all at once, that's the situation. That's a bit unusual. That has to be a macro story. It's not an individual economy or an individual state story. It's the overlaying foundation that is driving this right now. So, yeah, pretty cool, right?
It is very cool, man. It's very, very cool. I know there's a few points that you wanted to just run through over the course of the next 20 minutes. I think, let's delve into it.
Let's go through the first one. Cool. So, house prices are rising right now. House prices are rising at nearly 2% a quarter, 1.8% in the last quarter. So if you think of that's nationally. So if you think of that nationally, what you're seeing is, house prices are rising 7 to 8% at the moment, all across Australia. So our $11 trillion market is going to be 11 trillion plus 7%. Is that close to 12 trillion? Close-ish.
Probably.
Close-ish. It's 11.1 now, so it's close-ish to $12 trillion. So
that's insane.
Nearly $900 billion. I don't even know the math. Trillions kind of rig my brain out.
That's like 3 zeros, right?
Yeah, just a lot of zeros.
4 zeros.
Basically, $1 trillion of wealth is going to be $1 trillion of wealth is $1 trillion. What a headline! $1 trillion is going to be created.
Can you do it like this, like Dr. Reeves?
Is that how I'm supposed to say? $1 trillion is going to be created this financial year in wealth.
Yeah, that's absurd.
It's absurd, right?
God damn.
It's absurd. Yeah. So in absolute terms, that level of wealth creation that Aussies are going to experience, we're already the richest per capita country in the world. Like per person, one of its top 3. By the end of it, we'll be back to number 1 because of that individual wealth creation that happens. Obviously, this $1 trillion wealth creation isn't going to sit with everyone. You have 10 properties, so you're hoarding it.
Yeah,
you're a wealth hoarder.
I'm only 902 billion of that, so don't worry. There's plenty to go around. Calm down.
So That's what's happening right now. Like, $1 trillion wealth creation. I didn't even think of that. I just made it up while we're talking.
No, that's true.
Crazy, right?
That's right. And some of the markets, if we can just plug in some of the markets, that's at an average national level. Think about how many, I think it's like 11 million dwellings in Australia. Like that's a lot of wealth being generated at a national level. If you peel it back and talk about some of the markets that we've been talking about, there is, the Darwins. I think Darwin, based on totality, was something like 2.5% just in the month of July. I think it was annualized to be like 35%. That was
5% this quarter now.
5% this quarter. Like it's absurd what is going on, right?
Yeah.
So there are certain markets.
Curtis called me an idiot in that chair right there. Because
Really?
I told him that it'll rise 20% this financial year.
Wow.
And the first quarter is
And
past
he used
20%.
the idiot word.
Basically, he said it offline. He's just like, nah, that can't be right.
Yeah,
And like,
interesting.
He understood
And
because
you were
we've
like,
been talking
let
about
me
it.
go buy all the Darwin properties so it goes up. Is that what you did?
No, I rely on you for that.
Shots fired.
But like that was one that was easy to see because of this broader context. When you have this macro boom, it's made up of a lot of individuals investing,
Yep.
and now the individuals are investing in the same way, and
Yep.
that directs attention to this tiny little market that
Yep.
typically it's 400 purchases by investors. 300 purchases by investors every quarter. Now it's 800, being like, where'd the 500 properties go? That's all of Darwin's properties
Yep.
have just disappeared.
Yep.
Investors in one quarter,
Yep.
but there's next quarter too. What
Yep.
what is everyone going to buy next quarter?
Yep.
So the monthly sales volume, this is crazy. The amount of sales volume, they had to change the chart. Like they've changed the chart. Like they have to take Darwin off because it's consistent. It's like 5% is a big change
Yeah,
for anything.
of course.
Darwin's at 55%. It's just like, what? What's happening? Like, what is this market?
We're just going to leave it out for the time being.
Have we got this right?
reuse
Yeah,
it.
because the chart doesn't work anymore.
Yeah,
It's just
yeah.
like all the other ones just look tiny, and it's just like this.
Yeah,
So
interesting.
you got to take it off to make it like, yeah, it's a complete outlier
Yeah.
in many, many statistics at the moment. You're seeing that across the board.
But again, Darwin's
Melbourne's doing
just
well as well.
but Darwin's just a small part of this equation. I guess the point is, if nationally we are doing 2%, right? That includes all of the dwellings, every single place. There are markets that are well outperforming that, right? There's the Darwins, there's the Melbournes, there's parts of like regional Victoria or regional markets itself. They're like far exceeding like 2% a quarter,
Yeah, for sure.
So
Perth,
yeah, there is-
Adelaide, Brisbane. Perth, Adelaide, Brisbane, all doing well again this quarter.
Yep.
So that's good. Perth and
Yep.
Brisbane at 3%, Adelaide at 2%, Melbourne at 1%, Sydney at 1.7%. So
Yep.
the Melbourne one is, the reason why it's lower is because it's coming off a really low base.
Correct.
So in 6 months' time, you'll see Melbourne,
It's gonna flip.
that turn happens because Melbourne's gone from -2 to 1.
Yes.
So it's probably had a bigger turnaround impact. A bit like Darwin had a big turnaround impact. Perth has gone from, 3% this quarter, but it was a year ago or 18 months ago, it was running at 3% a quarter as well. So it's consistently continuing to increase in this everything everywhere boom after a period of like a 12-month slowdown. It's taken off again. So yeah, you're seeing it across the board. One of my key insights here is actually, and we've talked about this, is which market segment is going to do well. So the interesting thing about Melbourne and Sydney, our major capital markets, is the middle market is the middle. Like it's not the bottom end of the market. For the first time in 5 years, it's the middle market that's achieving the results. So you're looking at houses
Yep.
that are doing well. The houses above 750
Yep.
in that category segment, that's the part that's leading boom, which is what you expect when interest rates come down, where it's just like, I want to upgrade into a nicer market.
Yep.
You're seeing the reverse affordability
Correct.
frameworks kick in, and you see that in Sydney and Melbourne to begin with.
I love that. Can we just stress on that a little bit more? Like the last 3 years with the interest rates rising, everyone was chasing affordable markets, right? We want the 5% yield, we want the 6% yield. All it took, how many rate cuts have we had so far? Three. It's not a material change in your day-to-day cash flow, but the sentiment has completely changed. Now the conversation is, hey, my borrowing power allows me to go and buy a $700,000 property in a middle ring of like Melbourne. Sure, I can still go and buy a $450,000 property somewhere, but why wouldn't I put my money into a Melbourne metro market? And that's what we're kind of seeing. There's a resurgence of like activity in that. We talked about Werribee, we talked about Hoppers Crossing, we talked about Craigieburn at one point, we talked about Frankston. Obviously that price point has changed now. It's material. It's probably in the 800s now. But that's what's happening. People, the sentiment has changed, and now they're like, okay, it is affordability, but relatively it makes more sense to be in these markets, and there is a surge of activity happening there.
For sure.
Which is very exciting, man. Which is it's cool to see it play out over time.
So that's the segmenting of the market.
Correct.
Markets everywhere doing really, really well. Some markets doing better than others. Perth and Brisbane, very interesting markets as well because they're re-accelerating to rapid rates as well. 3% growth rates per quarter to begin the year. Perth going from 0 to 3 as well. Perth stopped growing.
Yeah,
now it's gone back to 3. So it's just like, it's a re-acceleration in house prices.
Yep.
That's really interesting. It's just like, this is everything everywhere boom. It's another leg in this housing boom. But it makes sense. Everyone's there. There's no housing supply. Housing demand's going to rise because of interest rate cuts. And also the $900 billion or the $1 trillion worth of wealth that's been created. I want a part of that. I want a part of that. That's what Perth people are looking at. So there's a lot of underlying reasons for that to happen. And the supply listing increase that's happening in Perth isn't enough to meet the housing demand increase that's happened. What I'm trying to say is there's a general demand increase. House prices are rising everywhere because demand has gone up. And regardless of whether Perth's getting more supply in than in its previous years and Adelaide getting more supply than what it previously done, it doesn't matter. Demand has gone up.
Massive.
That's what's happened. There's just a general demand increase, and when demand increases, prices rise.
Correct. But it's really interesting. We want to talk about point number 2, which is the exact opposite, right? Which is the supply aspect of this. Supply is at an all-time low in most of the markets that we're talking about, right? So there is a demand. There's a massive resurgence of demand, but a lot of the markets we're buying in, there is a huge imbalance between demand and supply, right? So that demand that we're talking about, which is being played out because of all these macroeconomic shifts that are happening broadly, sentiment changing, people's cash flow positions are better. They're like, oh yeah, I can invest again. That demand, like supply is not being built, right? It's like the houses are the houses. The houses are still taking ages. There's $1 million homes in 10 years. All of this nonsense that's being parroted by people in the government. It's just not going to come to fruition. That's the reality, right?
1.2 million.
1.2 million. That's right. In 5 years. That's right. Yeah, that was a funny little thing that happened.
When I think of housing dynamics, I love looking at supply figures, and in the data frameworks that we talk about, it's always about the supply figures because I know, watching property over 10-year periods, I know demand surges happen.
Yes.
Like right now, a demand surge has happened.
Yes.
Happened in May 2019. Huge demand surge happened off the back of a huge decline period. Happened in 2020, late 2020s. Again, a big demand from rate cuts. It's typically rate cuts that trigger a macro shift and big demand surge like nationally. It's often associated with rate cutting cycles. Those are the last 3 rate cutting cycles that I've just mentioned. Creates a demand rise. We know that happens periodically. We also know that once house prices rise, they don't typically fall back down, or they only fall back down a little bit. So the rise is there, and
it's a new baseline.
Exactly. So if you know demand is going to happen, a demand uplift is going to happen. You just need to time it where areas where supply levels aren't high at that point in time. Because if you have a lot of supply and demand is here and then demand goes up, it's just like, oh, cool, you'll soak it all up and then prices won't rise because it's back in equilibrium. But if you have a point where supply is constrained and it takes years to come in, like it's going to take time. Adelaide's still trying to solve it. Perth's still trying to solve it. They will get there, but it's taking time. And demand has just gone up again because we're in this. It's just like, oh shit. There's only one thing that could happen again. Prices rise again and they don't come back down. So you want to control the variable that you can control.
Yes.
And you can control supply numbers because they're consistent. They're slow. You can measure it. You can see it tracking. You get the time frame. You can't really control demand factors as much. You don't know why days on market's going down. You don't know why vendor discounting is going down. Like you can see it, but you don't know why. You can't see it. There's no reasonable explanation. You have to make predictions around those things. So we do that a lot here, where we make predictions. The next stage is rates are going to cut, and then this is going to happen. The median market's going to go up. We talk about that all the time. It's predictive behavior on demand. On supply, it's very different. It's not predictions. It's just let's just look. Let's just look at the ABS data. Let's look at where it is. Let's look at the framework of what housing construction is doing. You can measure it all, and you can even come up with a number. So that's why supply is so good to look at. It's consistent.
I think you've touched on something that in the property world, we obviously define markets. There's cooler markets, there's warm markets, there's hot markets. So here's a bit of a nugget for anyone that's watching that wants to do this themselves. The there's a transition period that happens when you go from, let's pick Mildura for a second. I bought in Mildura early last year, which is early 2024, when I would have considered it a warm market. When I went to bid on the property that my partner and I ended up buying, there was me and one other person. That was it. And the other person was like, a bit wishy-washy. They didn't really execute. So I was it was warm. It was like a coolish warm market. And the reason I went there, like why did I go there earlier than anyone else? Because I started seeing the kind of things that you're talking about. The demand hadn't come in yet. And I had no way of predicting when the demand would come. I had some inclination. That's not a variable that I can control. But you know what I did notice? There was nothing to buy in Mildura. The affordability was high. That was a big one. That was a big sort of tick for me. It was like, relative to the income that these people earn, the affordability factor for the median house price is actually really high. They can actually buy this quite comfortably. They can service the loans quite comfortably, right? And that's important. And it's probably not as important in the Sydney sort of metro market. It is important in regional, right? Regional is very, very important. So I was like, okay, affordability is high. There's abysmally low supply here. Demand will come because the yields are high. People will come here. So my conviction was I put all of those together and a bunch of other things. And I was like, yeah, let's buy there. So the transition from warm to hot doesn't actually get triggered by, it's the initial thing that you want to look at is the supply numbers. It's your stock on market, it's your inventory, it's your, the turnover of property, how long people hold, affordability. These are the triggers that you look for. The demand can be flat this whole time when you buy, it doesn't matter, because all it will take is a tiny bit of uptick in demand to absorb all of that existing stock. And after that, it's just a free-for-all. And this is exactly what's playing out in Mildura. So it's the supply numbers you want to look at if you want to find the next, hotspot of the future. If it's really trending down, there's no massive building approvals coming through, there's no massive supply issue that you can see in the next 2 to 3 years. Just remember, if it has those markers, that's the one that you want to be focusing on. Yeah.
You know why I like Melbourne a lot as well? I like Melbourne apartments a lot, actually. The reason why I like the Melbourne apartment story a fair bit is it's gone through an apartment wave, an apartment cycle, an apartment building wave. You can feel it when you go in Melbourne. You can just see so many buildings that have popped up over the past 5-10 years there. It looks like a different city in many respects. That phase, the next phase that we're in, because of feasibilities, there is no apartment wave coming forward. So we're going to go through a period of undersupply in the Melbourne unit market in time. It doesn't matter about planning approvals, it's just the feasibility concept. It doesn't work, so people aren't going to build. Sydney's going to go through the same thing, maybe not just yet, especially in the western parts of Sydney, so you're going to start seeing this. The reason why I like that is that's my controlled variable. I can control that variable. It's predictable, makes sense. It's visible in the housing construction forecast figures there. And you're seeing a gap between completion and approvals when you look at it. So I like it because I know the demand story for Melbourne. I know the underlying demand story is there. It's just like, hey, lots of migrants come in. It's got the highest population growth over long time periods. That will continue. Also, the weighting of our migration story will continue as well. Like it's pivoted from, Southeast, so from Eastern Asia to Southeast Asia. Our migration story is shifted. Australia's and the Southeast Asia story is more dominant in Melbourne than it is in Sydney, while the East Asia story is more dominant in Sydney.
Gotcha.
So the pivot in our migration programs is also promoting this as well. So there's all these underlying things where it's just like, But what I'm actually doing here is I'm looking at underlying high-level demand, but wishy-washy, being like there. What I'm looking at, like clearly, to identify exactly what to buy and where to buy, is that the supply constraints there, and it's like more scientific. Being like, I can scientifically prove this is what supply figures are going to look like here because I've got approval figures here and approvals track completions and I can run feasibilities. And I'm like, what's going on? Why are approvals coming down in this particular geographic location? So that's why I'm looking at opportunities like that because the science makes sense. So the supply story is really, really interesting as well. It's tight. Listings 20% below the 5-year average at the moment. Demand is high. That's what's causing prices to rise. Point number 3. I really like this one. Investors are back and firing. What do you think, man?
Yeah, man. Yeah.
You feeling it?
I mean, obviously we're an investor-focused agency. I can just talk from my own experience, the surge of demand that we've seen. Probably a bit of sentiment change. There's a affordability factor somewhere in there. I mean, at least from an Alea story perspective, yeah, investors are back. Or at least they're back to us. I don't know what's going on anywhere else, but yeah, investors are back. And it's funny because they're all concentrated around the similar price point. They are targeting the 700 to 900 band, which is funny because we spoke about this at length 4 or 5 months ago. 99% of our purchases have been in that sort of band. I made up that number, could be 98, but it's a very high number relative to everything that we're buying. Because the affordability just makes sense in that sort of, in that band. Investors are back, man. I mean, the conversations around yields is better, I feel. Like they're not as yield conscious at the time as well because the sentiment's changing. They can see the macroeconomics, like the interest rate cuts continuing now that it's happened 2 or 3 times. It's just different. And I think, honestly, we have seen nothing yet. I think we are going to see a surge in activity for more investors coming in, more confidence coming into the market. I know obviously there's, schemes and things happening at the homeowner level as well, which is going to change the dynamic, and it's something we're going to go through. But
yep, I think the schemes, the $1.5 million, the October 1 first-time buyer scheme, I think it actually again shifts the market profile up. So unpacking this scheme, one of the big trending schemes is the Australian government has increased the first home guarantee scheme to an unlimited amount of placements. This allows a 5% deposit for any first home buyers to purchase. Now, this scheme's been around for a long time.
Yes.
People have been using it. And there hasn't been a supply shortage of this scheme. So changing the cap levels doesn't change anything. People have been able to access this scheme with major banks. We do plenty of loans like this. But the difference is they've changed the price caps and they've removed the income criteria.
Yes.
So you can make as much money as you want and you can buy up to significantly more, $1.5 million in Sydney. And I think it's 1.2 but it's significantly higher in Melbourne as well. So when you do the math there, it's just like, what's changed? It's like anyone buying in the 750, nothing's changed for them, right? Because you don't make 300 grand and then buy an owner occupier for 700,000. That's not what people do. They go buy where they want to live. And if you were, you probably don't have a 5% deposit because if you own 300 grand, why do you have a 5% deposit on a $700,000 house? This is really, really important for that market because you now have a pool of buyers buying between that, the 800 to 1.5 market. The middle quartile is going to go boom.
Yes.
Right? It's just a huge demand increase that they didn't have before. The other markets actually don't see any benefit because they were getting it before. There's no change there.
Nothing has shifted.
So you'll see quartile management there as well with that change. There's one thing I did want to share with these lending stats. Let's see if I can pull it up again, is the breakdown of it in terms of states. I love looking at lending data by location because it tells me finance and lending. This is what I'm looking for. So when I look at investor stats, almost everywhere has increased. This is going to take me, I'm going to have to pull my computer out and look very, very close here. I'm going to go through this one by one.
Let's do it.
Okay. So I'm breaking down here what investors are doing in each state to work out where the investors are. And you could do this by looking narrowly at finance lending data. Because an investor gets debt from a bank and that bank records where that person is purchasing regardless of where they're from. And they can correlate that data over long time periods. So in Northern Territory, the average percentage of investor lending is somewhere around 20-ish%. Right now, it's 44.2%.
Whoa.
So the value of total investor lending as a proportion is investors make up more than double triple what they're typically doing at the moment. So Northern Territory, investors are there dramatically, pushing up house prices. Tasmania, they're not there. ACT, they're not there. They're both below average or in and around the average. In WA, again, the average is around 25%, and it's about 36% there. South Australia, investors make up more than they usually do. Queensland, more than they usually do. Victoria is even.
Really?
Investors are starting to get there because investors have been selling out to other investors to begin with. This is what will change. This number's going to change.
Yeah, of course.
We'll look back at this in 6 months and be like, investors make up more than what they typically do. And in New South Wales always has the highest number of investors. Like it makes up a bigger portion of the marketplace. I think I mentioned that to you in a different pod. It's kind of an outlier as well. It sits around 40%. Well, the rest of the market's at 30%. So most investors are Sydney-siders investing in Sydney. That's also above the actual amount as well. So the big surge is in WA at the moment. over
And
the last-
Darwin, right?
Yeah, the big surge is WA over 4 or 5 years.
Okay.
Like it's over a 4 or 5 year period. And Darwin at the moment is, rocking compared to what it's previously doing. So
Makes sense.
there's a little bit of a state by state overlay on what's
So how
going
would you,
on.
if you're just if you're just listening to this, what do you do with that information? Like that, it's interesting. So what is that telling you? That there's more people looking to invest just generally?
Yes.
Some markets are benefiting more from investor activity. There's the WAs, and the profiles are now changing quite dramatically in a bi-yearly basis, probably even quarterly basis. I reckon in a quarter's time, when the same report comes out, Victoria is going to look different, right? Is that the fair sort of interpretation of the information?
Yes. And there's one additional layer I'd add on top of that is it's an everything everywhere boom at the moment. The government has just given a water spray to first home buyers, being like, whoa, I can now compete. Investors are increasing as well at the same time. So you now have investors fighting against first home buyers at exactly the same time. And to help the first home buyers, the government's given them a little bit more ability to be there. Go take on more debt is basically what they're going and telling them will help you. What that means, I'd like to be a property seller. I'd like to own property yesterday. That's what it tells you, because your two biggest buyer pools that make up 70%, 65% of first-time buyers about 20, and investors in this scenario about 20. So 60% of the market are fighting over your property at the moment because there's a big increase in both of those. And naturally, owner-occupiers also, they've been given across the board $1 trillion in wealth that they didn't have over the course of the year. That naturally means should I upgrade my home? That's what people do when they have more equity than they had previously thought and good incomes behind them. Everything, everywhere, boom. Happening. It's going to be here for a little bit of time. That's kind of what this tells me. It's going to be here for a year or two. As long as ANZ don't fire everybody.
Shots fired.
As long as everyone keeps their jobs, it's going to be there for a little bit.
So again, translating that, right? What we are hearing is that supply, it's the same story, I guess, but it's just more pronounced now. You have 2 to 3 of the biggest buyer pools absorbing a lot of stock in a lot of places. That stock is lower than it's ever been. You said 20%? Is that what you said? Over the 5-year average? 20% lower listings?
Yes.
So there's lower available stock to buy, but there's even more people coming in. In what scenario, in what world does that not lead to further price growth, right? That's where the everywhere, boom thing comes from. And that it's just objective data. And that we're already seeing that play out, I guess, nationally. 2% nationally is a wild concept considering there's 10 million homes out there. Some markets are obviously benefiting more than others. The Darwins, the Melbournes, the regional, Victoria markets like Mildura, etc., Hamilton. It's so fascinating, man. I want to start buying properties again.
It is.
Instead of building businesses.
The last, you can do both. It's a very powerful way of wealth creation. It's very, very powerful. We often
takes so
teach
much
that.
effort.
Yeah.
So much paperwork.
You got this. You got this. You got this. The last thing I want to touch on was the rental market, because it gives me a lot of insights as well as to what's going on.
Yes.
So in the rental market, we have annual rents up about 4%.
Wow.
Increase has happened again. It plateaued and then it started rising again. Canberra 2.6% over the course of the year. Maybe I can see if I can get 3-month data. Anyway, I'll share annual data. This is the best thing. Darwin, 7.6% increase in rents and rising quickly. All these investors have rocked up, but rents are going up fast. Darwin will keep rising. Darwin will keep rising fast. I have conviction in, I think I said it a couple of times where I thought Darwin property prices could double. It's getting stronger, that conviction. The one piece of evidence, I need one evidence piece, and it was the one risk point, is what happens when all these investors rock up? What happens to rents? Rents are going up. It's the fastest growing rent cycle in Australia. That conviction, because yields will compress, of course, but if rents go up 10% and then go up 20% or go up 30% in total, prices can easily double. It's just it's catching up 15 years of growth. It's got a doubling happening at the moment, and you're already paying 100, 200 grand more. It's just so early on its cycle. This sounds so crazy because prices are higher. I now have increased conviction and be maybe it makes sense to buy in Darwin at the moment because prices are rising and rents are rising. The rents are rising is a huge story there.
That is actually a huge story. That's insane. I knew it was rising because we've obviously seen it play out with a lot of our properties. I own a property in Darwin as well that I bought a couple of months ago. I know my rents are going up as well at some point. I just didn't realize that on average it's sitting at 7.5%. That's a material number at an average level. So that's
I have a second insight for you, and I really want us to look into it more deeply. We'll do a different podcast on it as well.
Let's do it.
Hobart rents are up 6.2%.
Yes.
Tasmania rents are up 6.2%. But if you go back to the growth story that we touched on at the beginning, Hobart's the only city. It's ruining it. It's ruining my line. The everything everywhere boom that happens. Hobart is down negative 0.1%. Last month it was only up 0.1%, so it's done nothing in 2 months, and it's ruining the same because it's not booming everywhere. In Hobart, it's not. But rents are rising. Rents have been rising for a little bit of time now. I've been saying that repeatedly. Rents are rising. Yields go up. The one variable that needs to be looked at is what is happening to supply in these areas.
Yes.
There's supply downsides, and demand will come eventually and soon enough. The pot and the water is there. It's cold. It's very, very cold at the moment. But there are early signal signs with the rental story there. If you correspond it with the supply side issue that's there, you start seeing it looking more and more attractive. And then you need this yield. The problem with Hobart is the yield got compressed so low where it's just like, I'm not that interested. But the yield...
You went through a boom, right? Every market goes through that. Like it's a Townsville story, you know?
Exactly.
It's the same thing, man. It's the same thing that happens in different markets, right? It's just a rinse and repeat. People just have short memories, you know? People think Hobart sucks now. In 2 years' time, people will think Townsville sucks. In 3 years' time, they'll think Mackay sucks. And they'll forget that, you know, they were flogging Mackay like there was no tomorrow 3 years ago. It's just I honestly, I am leaning into more and more of the Hobart story. We've started to look into Tasmania a lot more as a company. It's a bit of a nugget. We have started purchasing in some of the more regional markets as well. But yeah, there's definitely an element of rents play a huge role in just sort of reading the data a little bit more, a little bit differently. You know, if you can couple the supply thing with like rents are rising, you know what happens? Investors start thinking, oh, that's pretty attractive. I haven't seen a 5% yield anywhere. Let me try this. You know, it happened in a lot of those Elizabeth Downs, Elizabeth Park area in like South Australia, right? Very low socioeconomic, very, very attractive yields. No one wanted to buy there. There was a horde of investor activity. They doubled in like 2-3 years. The yields have compressed. No one's there anymore. You know, there's just this cycle that you go through. So my very long-winded way of saying Hobart, yes, cool. It'll get less. You know, it'll get it's on the pot. Someone has poured the water in. So
yes, it's there.
Yeah.
So yeah, that's the rental story as well. So you broadly have very, very positive conditions for Australian housing, and the only risk factor I see, the main risk factor I see, is just the health of the broader Australian economy through this period and the uncertainties around job creation. But right now, the data there's pretty healthy as well. So pretty positive story across all different sectors there. We went through so many different nuggets there, so many investor lending segments, so many insights there, working out which markets are doing well right now, why Perth and Brisbane are improving, the interesting nugget about Darwin's rental market, anecdote about Hobart's rental market, the Melbourne story as to what is going to happen there, which segments are going to do well, the rise in Sydney that's happening right now, Hobart ruining my favourite line that I've been saying there a lot.
Not for long. But you're going to look like a genius in a year. But
being interesting. Just so many great there's a story to this housing story, and that's kind of what we unpacked here and shared with you all in this episode.